let's see if I can do as well as Ben did running this electronic advice. I probably will do less well, Ben. You did less well than Jeremy, so that leaves our last speaker not even knowing how to run it, I guess. I think that both Jeremy and Ben gave us some great information. I think Ben's comment on would you like to be spending 3 months in Scottsdale and then going fishing in Canada and all that is probably the most important thing I heard this morning. The biggest thing I see in businesses is the owner that is working 24 hours a day, every day, 7 days a week. And he feels that someday somebody's going to come along and buy his business. But there's really nobody interested in buying a business where the business is the owner. And so those of you that are not going golfing today, you may have an issue. Those of you that are have probably already figured that part out. And your business is much more ready for sale. Now, I'm asked to speak this morning on a topic of life insurance, which is probably one of the toughest topics to speak about because people always think we're going to sell you something and therefore we don't want to buy it, so we're going to tune out. I think Jeremy said that the SBA may require life insurance, and I think in our business, when we're required to do something, the three partners get together and we decide who can we call to get rid of this requirement as quick as we can because we don't know anything about it. Well, I'm here this morning to alert you that when the SBA tells you to buy life insurance, you could have some real screw-ups if you don't do it with the right people. Life insurance is not simply a product to purchase. It's a product to understand all of the elements of it so that when it is purchased, it doesn't get screwed up. And so I'm going to talk mostly about how to screw it up so that you can get a feeling, did we screw it up or did we not screw it up if you happen to have any of this stuff. See, already I'm winning on this thing where it isn't clicking. I predicted pretty well how this would work. I'm just supposed to push, right? Yeah, isn't it complex here? Just a little bit about our firm. Business and Estate Advisors was formed in 1977. And that was following, I started in the business in 1968, and so I formed the business then, and it's evolved over the last 42 years to a fairly significant business in what we do. We do three different things. We do business transition planning, which is primarily what I do, and I'm about 90% transitioned. And my hair keeps kind of leading a little closer, so as it's going, I get more transitioned. So it's got direct indication as to what's happened to my head over these years. But the key to my transition has been able to spend that 3 months in Palm Springs and to go to Canada fishing and do everything he said. I really liked that, Ben. That was a really good chart. But in order to do that, you need an extremely good team following you. So it's extremely important that you have very quality people coming up the line. And the one thing we did in our firm, we decided that no one could be a partner in our firm unless they were a certified financial planner or greater. We're the only firm in this part of the world that requires that in order to talk to anybody. None of our other associates are allowed to, they can visit if they're in the room with one of the partners that's certified. So I handled up the business transition. Steve handles the comprehensive planning. Now, most of our work involves total work with the customer as opposed to just the transition. Because there's a lot of pieces going on, and it's kind of like a surgeon. If we're going to operate on your arm and we don't know anything about your heart, you could kind of get screwed up. So it's important in transition planning that all the other pieces are understood. And our third partner, Sarah, handles the qualified plans or the retirement plans. And one way to exit a business, for example, if you are a 724 person and are always going to be a 724 person, maybe what you should do is just take all the money you have coming into the business and tuck it into a retirement plan and then just close the doors. Because maybe you'll get the most money by getting it away from Uncle Sam into that retirement plan and then just having your own retirement that way. So we look at those, the three different parts of planning. What we're going to talk about today is purely the life insurance side of the buy-sell agreements. These 5 things I think are going to be crucial to your understanding. The first is triangulation, and we'll answer in a minute what that is. The second and the biggest gotcha out there in today's world is the IRS Form 101J. That's accountant types and attorney types and financial advisor types. We just love to throw these code words around. We probably made that up. I mean, you don't know anyway, so we could just come up with any number we wanted, and you say, well, they must know something. But the truth is, somebody decided to get to letter J of Section 101 of the code, so we're going to talk about that. Cash values in cross-purchase agreements. Some of you may own life insurance to fund your buy-sell agreements, and you may have cash value style life insurance. Are premiums for buy-sell insurance tax deductible? How many people in the room right now think premiums for buy-sell life insurance are tax deductible? Well, pretty smart group. And then we're going to talk a little bit about defining disability, because in addition to the life insurance risk in a buy-sell agreement, you have the risk of your partner becoming disabled. I'm going to choose today to kind of use an Ann Landers approach to this, sort of what Jeremy did in case studies, I guess. And all of these are real case studies that we have worked with over the years. But in this first scenario, we're dealing with a $500,000 life insurance policy where the insured died. So now we have a dead guy. The insured was the father. The owner of the policy was the son, and the beneficiary was the mother. At the father's death, which of the following is true? Number 1, mom receives $500,000 income tax-free from the life insurance company and no longer owns any rights to the business. Number 2, son owns the business with no capital gains tax treatment to dad or mom. Number 3, son is deemed to make a $500,000 gift to mom and still does not own the business. Number 4, everything works per the buy-sell agreement. The deceased dad sells the business to son and mom is paid in full. Which do you think is the right answer? How many vote for number 1? How many vote for number 2? How many decided not to vote? How many vote for number 3? There are a few votes for number 3. How many vote for number 4? Number 3 is the correct answer. This is an actual case. This is where likely the person decided they needed some buy-sell insurance, just called up the first person in the phone book. Person came out and thought, well, this makes sense. We want to make certain mom gets the money. We'll make her the beneficiary. And now we are talking about that very first word I used called triangulation. There are 3 parties to a life insurance contract: the insured, the owner, and the beneficiary. In this case, the insured was the dad. That made sense. The owner was the son. That made sense. The screw-up was the beneficiary was the mom. So upon dad's death, the insurance company is obligated to send mom the $500,000. Since the son owned it, that was a gift from the son to the mom. And mom still owns the stock because the buy-sell agreement said upon death, the son will purchase the stock from the mom, but the son doesn't have any money now because the mom does. A simple thing by having the wrong beneficiary, which should have been the son, totally messed this deal up and used up $500,000 of a young son's lifetime exemption for gifting and estate tax purposes. So, first rule I would recommend is if you're going to purchase insurance from the first guy in the phone book, make sure they have malpractice. Because I think Gary would like to get at this guy. I already covered this, but that's what the triangulation is. Make certain when you have a life insurance contract that 2 of the 3 people are the same person. Now keep that in mind. The insured could also be the owner of a policy and name someone the beneficiary. The owner and the beneficiary could be someone and the insured would be someone. It would be impossible for the insured to be the beneficiary. Because he's the dead guy. Well, I guess we could put a check in the casket. It would be a good deal for the insurance company, but that'd be about it. So always 2 of the 3 should be the same entity. Now, it wouldn't have to be a person. It could be a corporation. Scenario number 2, this is Section 101J. Life insurance proceeds are income tax free as long as each of the employee owners acknowledges in writing to be in compliance. Now, what does it take to be in compliance? Number one, before any applications are signed and dated. Number two, after the applications are signed and dated and before the policy is actually issued, which means during the underwriting process. Number three, anytime during the first year the policies are enforced, anytime prior to the death of the employee owners. How many think number one is the correct answer? One person. Number two, correct answer. Number three, few votes. Number four. The correct answer here is number one. This is a very, very rigid law. There is no corrections to the law. If you do not give notice to everybody that you're going to buy insurance on their life prior to buying the insurance, you cannot fix it. Period. The only way you can repair it is to buy a new policy from a different insurer once you know the rules. So this only occurs to policies purchased after, I think it's 2005. Let me get the right date on here. I guess I'll know the answer in the next one. I think it's June of 2005, but I'll give you the date. So anytime a policy is purchased after that by entity meaning any employer-owned policy, and this is basically, and I'm in the business, you probably aren't aware of this, but Walmart purchased thousands of policies on everybody that worked for Walmart. And they did it on what's called a guaranteed issue basis. They didn't even really need the person's permission to do it. And so they called it janitor insurance, and it was a way Walmart was going to fund all of its health insurance. Because people do die, and when you're as big as Walmart, you can make money by people dying. Well, somebody in Texas decided to sue Walmart when their husband died because Walmart got $150,000 for this life insurance they own, and the widow got nothing. That went all the way to the Supreme Court, and Walmart ultimately lost, and this was the result of this new law. You can't buy insurance on somebody that doesn't know it. So that's why this 101J exists. So I think I've already given you the answer to this true or false one. And I guess I don't have the date in there. I thought I'd put it in. But at any rate, anything you purchased in roughly the last 5 years, if you purchase it without signing this document, when death occurs, there will be a taxable event which could have been tax-free by purely signing a statement beforehand acknowledging you knew they were going to do that. And it doesn't make any difference even if you own the company if you're doing that. That's the way the rules are. It's actually, when it passed Congress, it was considered a revenue creation bill. So the plan was there'll be enough people that screw this up that we'll make money on it. The next one is scenario number 4, and that's cash values in a cross-purchase agreement. What's the potential problem with this double-purpose scenario? Now, what do I mean by double purpose? When you build up cash value in a policy, oftentimes it's used in case we don't die, we want to use this money as the down payment to buy out our partner when we're all alive. And frankly, when I started in the life insurance business, 1 in 3 people was dead by the time you were my age. I'm 65 today. My guess is now there's 1 in 30 people dead. So most people are not dying, so there may be a case where they'll be bought out for a living. So even though the SBA may require the life insurance, it's seldom that it's actually used anymore. People just aren't tending to die. And that's why people tend to say, well, why do I even need to buy it? Well, if you are the one that dies, maybe that's why. There aren't very many that die, and that's also why you've seen rates come down. And by the way, on rates coming down, they've gone up probably 15 to 20% since January of this year. Keep in mind, life insurance companies make their money in only 2 ways. Interest on your money, premiums on your money. They're making nothing right now. So what do? Raise premiums. So for the first time in my career, we've seen premiums go up this year, where in the past they were going down. Now, what's the potential problem when you build up cash in a policy to fund your partner? A cross-purchase agreement says, I will purchase insurance on you, and you will purchase insurance on me. We'll be beneficiaries of each other's policy and owners. So I'm the owner and beneficiary, and you're the insured. I'm the insured, and you're the owner and beneficiary. In the same token, we're building up cash value when we pay these premiums. There's no problem at all when you do this. When the first partner dies, the other receives the death benefit. That would be correct. And buys out the deceased partner's estate. The policy is partner-owned automatically transfers to him from his partner's estate. That's first option. There's no problem. This is textbook buy-sell planning and everything works as planned. And number 3, there's a big problem. Over the years, the buy-sell agreement is covering $1 million business, $500 each. The cash values of the policy are now $250 each. The surviving partner receives $500,000 from the insurance company to pay the deceased estate, and now finds he has a significant cash value of $250,000 that he must purchase from the estate. Which one do you think is the correct answer here? To speed things, it's number 3. The biggest problem you'll see here in this classical buy-sell planning is the cash values are owned by the party that you now have to buy your own policy back. The correct way to do this is to use 2 policies, one that emphasizes death benefit and one that emphasizes cash value, so you build up cash value in your side of the ledger instead of on your partner's life, and then you just have a death benefit on your partner. And then you won't have this happen, and you'll have your cake and eat it too. So each partner secures what we call low premium, high death benefit insurance on their partner, and then item 2, you get exactly the opposite. Most people don't think of it this way, but what is high premium, low death benefit insurance? Now, why would you buy high premium, low death benefit insurance? Ben can give you that answer as I can, in the fact that there's some real tax advantages to building up money inside a life insurance policy. I have probably $1.5 million of cash values in my personal policies, and I make somewhere between 5 and 10% every year, and I don't pay a nickel of tax on it. So it's kind of like having a Roth. And when I do go on Social Security, it won't count against my Social Security income when I take money out of it. So it's pretty effective if you do build up money in them. Now here's one I thought I'd throw in. Using a 401k plan to purchase life insurance policies. First of all, do you think it's legal? Second of all, if it is legal, would the death benefit still be tax-free? Third, if it's legal, will the plan document need to be amended? And fourth, will the policy beneficiary be the surviving partner? How many think the concept is legal? It's 100% legal. Actually, the life insurance business started the pension business, and then eventually the mutual fund companies stole it from the life insurance companies. But life insurance has always been a provision that could be put into a tax-deductible retirement plan, but it can only be put into a profit-sharing style plan when you insure someone other than yourself. So if I'm going to insure my partner, I have to have a profit-sharing style plan, but you cannot have a 401k plan unless it's mounted to a body, which is called a profit-sharing plan. So a 401k would be an eligible company that could do this. Would the death benefit remain tax-free? I'm going to deduct my premium. Would the death benefit be tax-free? How many think it would be? How many think the death benefit would be taxable? Most think it would be taxable. No, the death benefit's still tax-free, again, under a provision. The life insurance companies owned this part of the business at one time, so that part still comes tax-free. So it's really the only place you can have tax-deductible life insurance within a retirement plan. Both of my partners, for example, own life insurance on me through their retirement plan accounts. If it is legal, will the plan document need to be amended? True or false? Likely the answer here is true. Most plan documents are put together by trust companies or mutual fund-oriented companies or people that are more after the money than the life insurance part, and they don't want to administer this, so they just say no. But most of the documents, if you have a plan, went and read your document, you could just check a box and say, now it's yes. And then you could have life insurance. And 95% of the plan documents done in the United States today are done out of a firm out of Colorado. And so they're virtually mostly the same, most of the offices, whether it be an administration firm like we are or a law firm that chooses to be in this business. And you just check a box and now you're legal to have life insurance in the plan. But if your box wasn't checked, your plan administrator is probably going to charge you $250 to recheck the box. Our theory has always been check the box when you start in case you ever need it, you can do it. Will the policy beneficiary be the surviving partner? How many think it would be, if I'm going to own insurance on my partner, will I be the beneficiary if I buy it through the plan? How many think that would be the way to do it? Actually, because the plan owns it, remember triangulation? The plan must be the beneficiary. So if I buy a policy from company X, the policy is owned by the XYZ corporation, which I own, and the XYZ corporation profit sharing plan is the beneficiary. So how do I get the money to me? I have my profit sharing plan have a beneficiary designation that says all tax-free proceeds of life insurance shall be transferred directly to me should my partner die. So there's two beneficiary forms is what I'm saying. One with the insurance company and one with the plan. Kind of like Ben said, he likes it. We like this too because it's really complex. If you want to do this with us, you can't do it with anybody else because you'll never figure out how to do it. But it's really cool. So it's one of those ways you can get a tax advantage. And I think my last scenario, and I'm sure I'm out of time, is disability defined. Generally speaking, when a buy-sell agreement is drafted, disability is defined as stated by a medical doctor. So a doctor determines what disability is. When one partner becomes disabled and wishes to exercise the terms of the contract, this almost always works exactly as planned. How many would say that would be true or false? That's kind of a giveaway. That one probably doesn't work too well. Number two, quite often this causes litigation as the non-disabled and disabled medical doctors differ on their opinion. That would probably be true. So underinsuring by acquiring buyout disability can greatly reduce litigation risk, and the answer to that is true. Disability buyout insurance usually causes sticker shock. So if you were to say, well, I think we should get some of this disability buyout insurance, and you get a price on it, you say, we might as well close our doors because we can't afford to pay that premium. But what we would recommend is you buy the smallest policy available so you have some independent third party define what disability is. Obviously, the insurance company does not want to pay unless you're truly disabled. So they have the right interest in saying, if we're going to pay, then we shouldn't have to argue about the doctors saying it's right or wrong. So our feeling there is if you want that area covered, don't use the Social Security definition, don't use the medical doctor argument definition. Just get a disability company to say, we'll pay out whatever, maybe they'll issue a policy for $50,000 or something, and then you can have a very simple thing, and then the rest of it you'll just determine through normal. Usually what happens there is you don't have to pay the disabled guy anymore, so you use his money to buy him out, but at least now you had something to define that. I think that wraps up probably more time than I was allotted. Yes, it does. Thank you.